we have something a little bit different. We have a panel this time. This panel is going to be about new capital market ecosystems here. It's going to be a discussion about technology behind the digital asset industry and Bitcoin being used to upgrade global capital markets trading and issuance infrastructure, excuse me. So I was just speaking with the guys. They're from all around the world, going to give a bunch of different perspectives about Bitcoin. I tried to learn their names, but they'll introduce themselves and a little bit of their backgrounds for you here in person. So they're going to discuss that, and we're going to get going right now. So thank you. Here we go. Come on up, guys.
All right, thanks a lot. So I think this is going to be a really interesting panel. I want to thank everyone for joining us today. My name is Jesse Knutson. I'm head of operations at Bitfinex Securities. We're one of a handful of platforms globally that's licensed and regulated to do security token issuances, both in primary markets and for secondary market trading. We were first regulated in the AIFC, a financial center in Astana, Kazakhstan, like Dubai or Abu Dhabi. And also we're the first global platform to be licensed under El Salvador's digital asset regime. So I think we're very lucky today to have some people really at the tip of the spear in the industry in terms of legal, regulatory, and on the business side. So maybe to start off, I'll let the guys introduce themselves first. So maybe we'll go right to left. So Juan, you want to start?
Hi, I'm Juan Carlos Reyes. I'm the president of the National Digital Association. We regulate digital assets in El Salvador.
My name is Michele Crivelli. I'm an asset manager in Switzerland. I recently incorporated a company in El Salvador called NextBridge. I'm the founder.
I am Bjorn Schmidtke. I'm the founder and CEO of Penguin Group. We are transforming energy into human potential by running data centers and Penguin Academy, where we train people to program in Paraguay.
Hi, I'm Tim Aaron. I'm a London-based lawyer. I'm head of compliance for Bitfinex Securities as well.
All right, so to kind of drive the conversation today, I've organized the topics into 5 main topics. So we've got opportunities and benefits, innovation, risks and challenges, my personal favorite, emerging markets versus financial centers. And then finally at the end, I think we could probably go on for hours, but I'd like to leave enough time for people to ask questions about security tokenization. Because we're fortunate to have people from all different perspectives with this ecosystem today. So maybe to kick it off, Tim, we'll start with you. As someone who has a background in both securities law and digital assets, what do you see as the primary opportunities and benefits of security tokenization?
I think the opportunities and benefits really stem from the technology. And it may overlap with some of the things you want to talk about later, Jesse, but the ability to access the market is central to this new technology. What you have with established financial centers is often creaking systems and a huge web of interactions between the various players. But what you end up with when you start looking at what the technology around tokenization can bring is you allow new financial centers to really spring up and to potentially start to challenge the existing financial centers. That brings with it all kinds of challenges, vested interests. Regulators have to start to adapt and develop new approaches to regulation. But basically at the core of it is the concept that the technology allows not just for innovation in terms of how entities can start to compete at the level with the existing financial centers, but also massive new opportunities in terms of the kind of offerings that can be given to the market as well.
Yes, so building off of that, Juan, how do you see the opportunities of security tokenization from your perspective in El Salvador?
Yeah, so El Salvador is not only the first country to legalize a digital asset as a national currency, it also has the government to have the foresight to make that digital asset Bitcoin, which is now our legal currency. So from our perspective, Bitcoin is, as you would use the US dollar. That has created catapulted El Salvador to be at the front when it comes to adoption and integration of opportunities in digital assets. Most of the world-leading consulting agencies sort of estimate that this market is, within the next 7 years, by 2030, about a $15 trillion market. And I believe El Salvador is posed to be one of the key players to take that tokenization or that opportunity of the digital market into the world and become a center of excellence.
That's great. Michele, what about your perspective from someone who's got a background in asset management? What do you see as the benefits and opportunities of security tokenization?
Well, I think tokenization will bring a lot of innovation in the financial industry because, for example, you can transform liquid asset in liquid assets. A security token actually acts as a liquidity collector where a liquid asset owner gets liquidity and the investor, the token holder, gets ownership on the underlying with the related returns. So this will be a big improvement in the market, and but also increases listed existing product liquidity, because if you think about a private equity fund, for example, which is by definition liquid, and where the entry barrier is very high, by tokenizing it, you can first of all reduce the minimum tradable amount. This will give more. This will lead more clients to get invested in this underlying, and you will be able to create a secondary market. So people will be able to trade on a liquid asset. And this will give us the opportunity as asset manager or issuers to raise more capital for investors to de-risk their overall exposure. But there are also other big innovation like 24/7 trading, for example, which is a huge improvement, or instant settlement, which is not the case in traditional markets, or cross-settlement. This will have a huge impact on traditional financial markets, because imagine that you need to sell traditional bond investment fund because you want to take an exposure on the equity market. Then you give your instruction order to your bank. You need to wait 2 days, at least 2 days, in order to get your money to reinvest in other assets. So you will delete this time lag. And then you also have a new global access, a new distribution channel. You don't need to invest any more assets in developing a sales department with salesmen that are knocking doors of banks and family offices in order to sell their product. So this will also be a huge improvement. And last but not least, you will be able to create product that doesn't exist yet and that could never exist in traditional markets, like, for example, Penguin's one. And all those aspects, there are many more aspects, but I think we should have a panel just for this. So all those aspects will help to increase the efficiency of financial markets.
Yeah, you really could. I think there's a lot to be said about that, especially real-time settlement. I think for people who trade Bitcoin and digital assets, it's probably a little bit, I don't think we fully appreciate how big of an advantage that could be to traditional markets. Most of my financial career is in Taiwan. And if you sell TSMC on Friday, T+2, that means you don't get your cash until next week, right? So there's, I just think, big benefits to real-time settlement in terms of cash management. You can churn it more efficiently, and also to risk management, right? Your cash isn't stuck with somebody else. So that's a big one that I don't think probably gets highlighted enough. You mentioned new products that haven't been created yet in conventional markets, things like tokenized hash rate contracts. So Bjorn, you guys are a Bitcoin miner. One of the themes of the last cycle was a lot of the big companies within the digital asset space, Coinbase, many of the miners, going to the NASDAQ. I always felt that was slightly disappointing to see the biggest companies in our space kind of running over to the NASDAQ. What is your thought on that? As someone who could potentially do an IPO at some point, doing an STO issuance versus doing a conventional IPO issuance?
So I think what we've seen in 2021, right, was like an incredible FOMO and everyone like running into NASDAQ and making listings, and we had incredible multiples and offerings going out there at the very peak of the market. And one case is Stronghold, right, IPOing at, I believe, something like $20, and now they're if they're still around, I believe half a dollar. Something like that, right? So, I mean, the performance is obviously not so great, and you had a bunch of analysts looking at it and being like, yeah, they bought some computers, it's gonna be good. And I think what a security token offering allows, on top of all of the things you guys already mentioned, is to segment a certain part of the business that is very interesting and eliminate some of the risks. For example, the risk that your C-level always wants to fly first class or private jets, right? And so I think this is a lot what we've seen from companies raising money in this market at the very top of the peak, where it made a lot of sense for them, but obviously they also had to allocate that market, buying in at extremely high prices for hardware and infrastructure. And obviously that's not a wise decision. And I think we see there how illogical markets are and how flawed markets can be. And by having STOs, it probably also allows you in the future to raise money in a time where the markets are low, right? And where kind of more you create products that work anti-cyclical to the whole industry. And I think that is a very interesting opportunity that, and of course, well, Bitcoin mining, if you're able to issue something like that on a layer 2 on top of Bitcoin, then it makes even more sense, right? Because it is already secured by the thing that you are securing with the work. So overall, I think it's a great innovation, and it allows to develop products that haven't been there before.
Yeah, that's great. So one of in our interactions with regulators, one thing that comes up quite a bit is how do regulators do their job of responsible regulation without crushing innovation? So I think El Salvador has done a really good job, maybe better than anyone, at kind of identifying the really accretive parts of the digital asset industry, Bitcoin, security tokens, while avoiding the other parts that could be slightly more problematic. So Juan, how have you guys navigated this? How have you managed to grasp this opportunity that even supposedly more advanced regulators in the G7 have kind of overlooked?
Yeah. So it's how do we support innovation while at the same time applying regulation? And I mean, the way CNET has approached it is a multi-pronged approach. One is we really have spent time finding top talent around the world. Second is we ensure that all of our staff is educated and continues a path of education of technology. And three, most importantly, is we do apply the regulation, but we do take a risk-based approach. And by saying that is that every single team member in our organization understands technology, and we look at every opportunity or every applicant as an opportunity for someone to come into the country and do something great, and try to identify the risk approach, and from that define how do we work with them to ensure that they meet the regulation, they abide by the law, but at the same time understanding that it's something innovative and it's something new, and it can grow in the ecosystem while being regulated. It's complex, it's hard. I mean, this is something new, not just for El Salvador, but for the world. It's something that regulation in El Salvador, it's a new topic. I mean, we're currently working with the legal systems to make sure that they understand the needs of the regulator and how to work with companies, that the communication flows both ways easily. So and that's probably the biggest challenge that we've faced so far.
Yeah, I think that's something that both El Salvador and the AIFC done really well as regulators, is to interact with business, and I find that they've been much more approachable, and I think that's really the key for regulators to identify where the real innovation is. Tim, the approach taken in the AIFC and El Salvador in some ways have been very different. I'm thinking specifically about how the regulation is structured. So in the AIFC, there's no legal difference between conventional securities and tokenized securities. In El Salvador, the structure is a little bit different. Anything that uses digital asset technology is explicitly not a security. It might be a security-like product. So what are your thoughts of that kind of structure? It's kind of a novel regime.
Yeah, I think it's a great idea, and what it allows the regulators to do is to look at the products in a fresh way. where you have sort of legacy financial systems and you have the idea of a security, there's so much in the way of a weight of legislation that's built around it. And half of it, if you ask anybody why it's there, they don't really remember. And it does potentially patch up some issue that happened 10 years ago, 20 years ago, but it doesn't necessarily deal with future issues. And you end up with a very weighty legislative system that doesn't really allow either regulators to be innovative in their approaches or for companies to do anything which is slightly different. So having the approach that they've taken in El Salvador, I have to say, as a securities lawyer, or as a financial services lawyer, it was a very fresh approach to it. I think for me, and I think it would be interesting to see how the market views it, because we're not dealing with spot digital assets here. We are still dealing with products that have a lot of the features and concepts of securities. In many senses, they are, of course, securities. Of course, they're digitized. So there are many creative ways a regulator could start to look at it, and maybe focusing much more on the technologies, the smart contracts, regulating that side of things, which traditional regulators just aren't doing yet. But at the same time, I think you'll have the market which will say, actually, we're buying something that looks and smells like a security. Where are protections? And of course, built into the legislation, there are disclosure regimes. And the market will have to take a view on the products that start to come across in exactly the same way they would do in a legacy system. Where I think it becomes, will be interesting to see over the years is to what extent can these disclosure regimes ensure that the market gets the transparency they need, and that really comes back to the regulator, and the regulator being flexible, the regulator being able to approach these things with enough authority to give the investors the confidence they need. It's not impossible, but it's a brave new world, and I think it's going to be really interesting to watch it develop.
Yeah, so one of the things people have been talking about in the STO industry probably the longest is the idea of tokenized funds. I think we've probably been talking about that for around 5 years already. So Michele, what is the draw of tokenized funds? What is the benefits of that? And why, 5 years out in 2023, do we have approximately 0 tokenized funds with secondary market trading?
Well, good question. Well, the advantage of tokenizing fund is basically to bring new investment opportunities on the blockchain. For example, there are not so many or any low-risk investment opportunities on the blockchain like as in traditional markets. So that's why there is a huge space for tokenized funds, like tokenized bond funds. And by the way, investor does not have to transfer their assets into banks in order to get this exposure, with all the related issues that usually those investors have. And regarding the illiquidity or missing secondary market, well, the adoption rate of security token is still very low. And the market is very fragmented. That means that when the market is looking for a specific need, for example, getting a yield, the market is filled with different solutions on different platforms with different standards. So there is no interoperability, and therefore you cannot have a proper secondary market. I think those are the main reasons, actually. And also maybe also the fact that you will need a common standard in order to be able to put together all those divided liquidity in all those platforms.
What about redemptions too? Because I think one of the use cases people have talked about is the idea that you can have a locked fund where people don't necessarily go to the fund for liquidity, but a closed fund, but they go to the market for liquidity. Do you see that as an opportunity as well? That's something that people talked about but never really seemed to develop. I think probably because we never really got the secondary market activity that was originally expected.
Well, I mean, basically when you build a secondary market, this is exactly the purpose of security tokenization. So yeah.
So from a fund manager's perspective, it just becomes a lot easier to manage the product.
Absolutely. It's game changer.
Bjorn, we touched on this earlier when we were talking about innovation, but when people think about security tokens, they think about bond, they think about equity, they think about funds. But as we touched on before, there's an opportunity to create more novel products. What are your thoughts on that?
So I mean, I think with all of this, what we see right now and what we're in is a maturing market, right? Like, what's new? The tech has been around for a while now, and we don't see adoption. Well, now we get regulation that actually makes sense. I'm always thinking back when the Swiss regulator FINMA came out and said, well, guys, if you do ICOs, like initial coin offerings, that's a security offering, and there is a law for that. It's not like something that's unregulated, but it's actually there. And everyone's like, oh, really? Not sure if that applies to us, and try to find a way around. And I think the very interesting thing here now is that there is a law, there is a regulation in place that allows this market to mature and more things to create with more, how to say that, with a perspective, right? Going forward with more seriosity and with enforcement behind that. So one thing that we're working on, which I think is key for us to have a regulatory framework that we can do that in, is something that is a forward basically on hash rate. So hash rate being one of the most interesting commodities in our time. How do you buy into it, right? And we had earlier this thing about NASDAQ and the companies that are listed that you can buy in, but why not being able to directly access hash rate and buy it as a commodity and trade it as a commodity to create a market around that? And so that is something we've been working on and thinking, okay, how can we make that in the best possible way to democratize hash rate and create a fair and transparent pricing, and also eliminate ourselves as much as possible as a counterparty risk, right? And I think that is one example of something that, well, it's again, right, a forward is nothing revolutionary. It's around since quite a while. But the really revolutionary thing here is that we're now having a regulatory framework around it. We have a market that is created. We have people that are coming in that are bringing more liquidity, that creates more trust, where we have more of an ecosystem that all comes together in order to allow something like that to happen, right? And I think that derivatives that can be built and that can evolve out of something like that are probably a driver of another huge adoption of digital technologies in the financial markets.
Yeah, I think tokenized hash rate contracts are a really exciting product. So of course, our first asset that we listed on the platform was the Blockstream mining note, which I think was the first real iteration of a security structured tokenized hash rate contract. And there is a lot of interest in that, but I think there's various ways that we could tweak that product to make it even more interesting. And I think the idea is also, I think, supportive to decentralization of Bitcoin, because you can kind of free up the miners from having to go to investment banks or VCs or whoever to raise capital, and we can kind of crowdfund that growth in hash rate, which I think is massively exciting and also something really good for Bitcoin. Moving on to risks and challenges, Tim, you're involved in basically all of our interactions with regulators. I was going to ask this to you to say, what do you think are the risks specific to security tokenization? But maybe this is better framed as, what do you think regulators think are the risks attached to security tokenization?
I think the regulators have, and I'm not talking about regulators necessarily here, but generally in the world.
The ones on stage.
Other regulators. I think they have a kind of knee-jerk reaction to anything to do with crypto. I think that, to be frank, most regulators I interact with have extremely close relationships with the traditional legacy financial sector, and I have no doubt whatsoever that those vested interests are in their ears constantly, pointing out everything negative they can. Even though, for example, I have a very close friend who's a very senior head of AI at a very large investment bank, and he says, look, we've been working at this stuff for 5-10 years now, but we can't roll it out, because the moment we roll it out, the whole web of our interactions with the brokers, the interdealer brokers, the settlement banks, all of those relationships that have taken us years to build up will suddenly fall away, because this technology actually allows us to have those direct interactions, and we don't need those relationships. So our huge competitive advantage has fallen away. So I think regulators have that in their ear. They also have to act within a regulatory and legislative framework that is very restrictive in terms of what they can regulate, how they can regulate, and they understand those systems and they understand what they can do, but in order to bring anything new to it, it would require new legislation being given to them and new powers being given to them, so that again restricts them and that makes them nervous. And I think those sort of two forces combine, and to be frank, I mean, I've spent a lot of time working with the UK regulator on a lot of things. I think there's a couple of other aspects which tie into it. One is, I think that regulators generally, and it may well explain the US approach more generally, I think they're very, very worried about what crypto means for their traditional means of taxation, and how it could potentially freeze up potential sources of national revenue through taxation. And I think that's in their minds as well. How do they deal with that? And they're not ready to, and they haven't got approaches to it. But also, I think that they see this new technology, and all of those factors combined mean that they don't really have an approach to it that works. Now, when you have a new financial center and a willingness to be supportive of the technology, it allows those things not necessarily to be in any way brushed under the carpet or not in any way confronted, but it allows regulators to actually think we have one opportunity here, which is to set up a new, potentially challenging system, which may well, in 5-10 years' time, be competitive with the likes of Singapore, Frankfurt, London. But I think that regulators, when they start to look at it, they probably step back a bit, because it will require such a fundamental undermining of what they've got. And even for new regulators, I think when they step back from it and look at it, they actually also have to think, well, hang on a second, we might have got rid of half of this web of sort of intermediaries that we don't necessarily need, but we also need to bring in people who properly understand finance, people who properly understand the sector, people who can speak the language, people who can speak to investors. And that takes time to build up. And to me, that actually is the real challenge. It's not so much the legislation, it's actually having the wider infrastructure in order to service the sector. And it's chicken and egg in a sense. How do you get that? Sorry, it's a very long answer. But how do you get that in? It's not necessarily the regulator's job, but the state's infrastructure needs to be there in order to build that out.
Yeah, that's such a good point, and I think we often get that question when we're speaking with potential investors, depending on where they fall in the conventional investor kind of scale, is, why are you guys in the AIFC in Kazakhstan? Why are you in El Salvador? In Kazakhstan, financial services are like 5% of the economy, right? So we just don't get that much pushback from the incumbent players, and there's just so much more reward and so much less risk, and I think that's kind of a similar situation in El Salvador, and these newer regimes have an opportunity to really streamline capital markets and basically put investors much closer to issuers, which I think is the ultimate goal. Maybe jumping into my favorite topic, emerging markets versus financial centers. Bjorn, your facilities are focused in Paraguay, but I think you probably have investors from around the world. What are your thoughts on this idea of emerging markets being able to leverage technology and closing the gap with existing financial systems, or maybe even by competing asymmetrically, jumping over them? Do you think this is a realistic possibility?
So I think what you said is very key, right? Like, kind of bringing the issuer much closer to the investor is very significant as a change, and of course creates some more, let's say, risk for us in a way that, like, we are more thinking about our issuance like a product, because we're directly facing our investors, and we're like, we need to make them happy, right? So there is no underwriter that's in the middle, and that's kind of protecting us from all of that legal and whatever implications. And on the other hand side, I think it's as revolutionary, as amazing as it is, that in a country like Paraguay, where, okay, we're not investment grade, we're one step away from it, eventually we'll get there, that will probably change the whole country and transform it, but meanwhile, we're able to go out and solve our capital raising in a completely different way, and kind of like leapfrog, so to say, over this, we're getting to investment grade directly to we're going to investors, right? And we're using a different platform for that. We're able to establish ourselves in a upcoming financial center that probably will see a lot of liquidity coming in. And I think the big chance of that as well is that connecting, like, we've seen a lot of financial innovation around the world in the last years. Especially, I think there's a lot of crazy stuff that happened in the second half of the 20th century, where you had the options market coming up, you had FX after Bretton Woods, you had real estate, securitizations, and all of these kind of like fundamentals created a massive boom. And what it really created is like tradable products, right? Standardized tradable products where there is a market with massive liquidity. And I'm thinking about is always like when you have something, and by the way, much of the emerging markets and world has been left out of that, right? These financial centers and these evolved financial products have mostly been focused in the Western world. And so now what we're seeing here, I believe, again, is an underlying technological innovation that allows another boom to happen. And I think that there are many emerging countries that this time hopefully can be part of that, especially due to this possibility to leapfrog into it, not being blocked by a lot of intermediaries and established systems as there are. And eventually there's a theory about, how's it called, the velocity of money, right? So generally the idea is the higher the velocity of money, the higher the wealth in an economy and the more it expands. And I think the same thing in a way applies to securities. The more velocity you bring into a securities market, the more wealth can expand and business can flow. And I think I see a good chance that this will happen. And for example, in our case, that Paraguay will profit out of that, and so the people, right? In our case, it's very special. We're transforming power into human potential. That's what we say. So with this security, part of the revenues go into the academy, go into the training of the people. And the most beautiful thing, it's kind of funny, we are training programmers. And these programmers, because all of this is underlying a technological thing, are now building these contracts on chain, right? And creating this innovation, pushing the frontiers of what's possible with Bitcoin and with Bitcoin script and locking scripts. And so it kind of comes back full circle. And I think that's hopefully not the only place where that happens and expands in many emerging markets.
All right, very good. We're at the 10-minute, we're past it. We're at 9 minutes left. So I want to quickly give the last two questions to Michele and Juan. And maybe if you guys could approach that question yourself, the emerging markets versus financial centers. So Juan, and try and keep it short so that we can get some questions from the audience. Juan, do you think this opportunity to upgrade the technology between capital markets, do you think this is an opportunity that's inherently skewed to smaller economies like El Salvador versus relative to financial centers?
Yeah, no, I definitely do. And going towards Tim's explanation about regulators, El Salvador, it's a very different regulator. I mean, having adopted Bitcoin as a national currency, having a president that has the foresight to see technology and embrace what's coming, and a lot of leaders that have come into the country. I mean, we have Max and Stacy and a lot of people that have served their purpose in developing the law that we have. Sets us apart because now we realize the difference between the traditional financial sector and how banks and the old institutions slow down the process. So therefore, since we don't actually have a national currency, we use the US dollar, it was fairly easy for us to create the digital assets law and have securities, which are digital assets, looked at under a different lens than the traditional financial markets. So it is a bit skewed because, I mean, in the States, what's really hampering the adoption of technology is the powerful industries, which are the banking industries, ensuring that they keep dominance of how the money is issued. So it does give El Salvador a very unique opportunity to become a leader. And I believe probably under 5 years, we will be able to show that El Salvador can become one of the top financial clearinghouses in the digital assets in the world. So
that'd be amazing. Michele, I think you've got one foot definitely in the old money world, but I think you understand the structural impediments of the old system better than anyone else here. So do you think that old money financial centers will be able to capitalize on this technological transition? You have 2 minutes.
Well, okay. Yes, they will. Yeah, they will. They will because history teaches us that you cannot stop evolution. And history also teaches us that this usually doesn't come without fighting, but this is another story. I believe that when traditional investors and Wall Street suites will feel comfortable with tokenization, things will change. And because the reality right now, unfortunately, is that traditional investors doesn't understand cryptocurrencies, doesn't understand Bitcoin, doesn't understand the difference between altcoins and NFTs. So this is stupid maybe, but this is the reality, and this is why billions of people in this world doesn't hold any cryptocurrency. So what if the next generation of cryptocurrency will be a cryptographic tokenization of real life things that people are dealing with on a daily basis? So this will probably change the perception of blockchain, of cryptocurrencies, and will increase the adoption rate. And when this will happen, financial markets will change forever. It will be the biggest change since the introduction of exchange-traded fund in the early 90s. And I simply believe that security tokens are the natural evolution of ETF. Yeah.
That's great. Thank you very much. So at this point, I'd like to open it up to audience questions. I think this is a pretty unique opportunity to speak to some of the people that are actually doing things in security tokens. Does anyone have any questions? There has to be one out there. Don't be that group of people. Yeah.
Paperwork and structures in order to list that security token on your exchange in that jurisdiction?
So I've learned my lesson from this time, or from last time, and this time I have legal representation on stage. So Tim, we'll give this one to you.
I thought you were going to answer that. So if you have this is all new, but if you have an idea to offer a tokenized security, we would suggest early discussions with Bitfinex as the potential secondary market trading venue. I think that those discussions really work around just understanding the product. As was said on the panel, in a sense, the removal of the sponsors, the investment banks, the underwriters, mean that those conversations become much more important, because I think we have a view and quite a good understanding of the secondary market. In El Salvador, there's also a concept of a certifier, which will provide some degree of comfort to the market about the documentation that's going to be provided at the point of issuance. And then there's also a legal review carried out by the regulator itself. So those processes are all in train, and they're all set out in the legislation. In terms of the extent to which Bitfinex Securities will help on the legal side, I don't see it like that, because we're the market. You ought to have your own legal advice in terms of the whole process, but to the extent we can assist on the sort of working through all of these new issues, we certainly will do that. And we have to sort of distance ourselves a bit, because we are also needing to approve the offering document and making sure that that covers what we expect our investors would require to be seen, and make sure it answers the questions we expect the best investors to do. So we'd have a conflict to the extent we're providing legal advice for the issuer as well.
But we also have, external counterparties that we've worked with in the past, and we can provide introductions in various regimes. Maybe another question here, the young gentleman in the second row there.
The young one, the young one.
Oh, thank you. You can go after me.
Ouch.
Sorry, I think the speaker meant the older gentleman there. So thank you very much to the panel for a very very detailed and interesting overview of the topics that have been raised. But moving beyond the sort of the regulatory and the enforcement questions, which are very very important to address, something that I've been thinking about for a while now, having had a career in the traditional finance industry and witnessed all sorts of shenanigans that go on in the regulated world, something the closer nexus between issuers or builders of products and services and their clients or investors who are reliant on a sort of more ethical way of doing business is something which I think is going to come to the forefront perhaps going forwards in a world where there's this closer nexus between those parties without the intermediaries who in the past, people who are not honest actors, so to speak, have had the chance to hide behind. So you've got companies which don't.
I think that's a really interesting point.
Wondering if the panel has some thoughts on that. Thanks.
Yeah, I think that's a really interesting point and a kind of unexpected benefit of streamlining the system and having investors interact more directly with issuers in this whole process of disintermediation. That's a really good point. Yeah, I mean, first of all, I would say that most of these issuances are done on the blockchain. So from a technology perspective, there's certain public things that happen in terms of the interaction in the market. Maybe Tim, you could speak briefly on ongoing reporting obligations and disclosures in each of the regime, just maybe very high level.
Yeah, I think that one of the real tests of the regime, in any regime in this space, would be the ongoing disclosures and making sure I think that the regime is very much drafted with the idea of disclosures at the point of issuance, but the real test of it will be ensuring that the market obtains that transparency throughout the life cycle of the product. If it doesn't, I think that there will be immense investor backlash, and I don't think investors will have the tolerance they've had in the spot digital asset space. So really, I think to me that's the test, and whether that transparency is right. And it comes down, I think it picks up on the previous question as well, because when you have the closeness between the investors and the various service providers, you haven't got a lot of those actors whose role really is to ensure that they understand their obligations. The investment banks, whatever you might say about them, they will also bang heads together, kick the board around, make sure that they understand their obligations on an ongoing basis, because in a sense they're next on the line if it's wrong. The removal of those actors puts a lot more pressure on the issuer, and making sure the issuer has an understanding of their obligations to the market. And I think in all of these things, one mess up will be a significant mess up down the line. So it puts a huge amount of weight on the regulator, it puts weight on us as a platform, which we probably wouldn't have in the traditional space. But yeah, I mean, we've got to ensure that there are good actors, and of course, it's very difficult to do at this stage.
Maybe to wrap things up very quickly, I'd say that one of the primary differences between ICOs and STOs is that you have a regulator that sets rules, and there's clearly defined obligations for the issuer, and then clearly defined rights for the investor. So I see that as one of the primary distinctions between the two. Unfortunately, we're at like -3 minutes now. We've gone over time. I think this is a topic that really needs like an hour and a half. I think it's very, very exciting. And I think you're going to see more interest and more action in this space over the next probably couple of quarters. So I'd say stay tuned. And thank you very much for joining our panel today. And thank you to the panelists for participating as well.